Um, Thank you for making it on. I created a list of questions. Usually the conversation doesn't follow the questions just because a lot of times the answer will answer another question on the list. So we'll just kind of flow through the conversation. I heard where I got wind of you and your background and all that stuff, your expertise. I was on a talk, I think you guys did it about a week ago. So it'll be kind of cool to talk about those things. It seemed like you talked about a lot of like tax planning.
Okay, yeah.
And a lot of people, and my mom is really big on this. She's really big on tax planning. So it'd be kind of cool to talk about that. I don't even think people are even familiar with the concept. They kind of deal with their taxes at the end of the year instead of before. So that'd be kind of cool to expose people to. And then I also saw that you invest in real estate. So
no, not really.
Got it.
I know real estate. My background is when I started practicing law, I was a title attorney in West Virginia. So I know real estate law. I also run the sheriff's sale for the city of Philadelphia.
Wow.
So those are kind of things that I do like in my law, my legal practice. I don't really invest in real estate. I don't really invest in real estate. And it's not that I don't have a desire to, it's just that I don't even know. I mean, like I'm so used to, I think you just do what you're used to. I'm so used to investing in the stock market. I'm just kind of like, but I have some cash. I can do this right now. See, I have a company. I like this company. I'm going to buy it. As opposed to, okay, I want this house. I got to put in a bid for this house. Or, if I do a private sale, I roll up to the person. I'm like, hey, can we do this? And then, it's kind of like, ugh. But then I have to do a title report. I also have to do an inspection. Oh, this is so much.
That's
but
cool.
If you talk to a real estate investor, on the other side, there's like, well, how do I know this company is good? I can't touch that company. And it's just, so it's interesting to have these conversations with real estate investors. But yes, I know real estate. I just don't invest in it. So if that answers your question. I own real estate, but I don't invest.
So you own like your personal residence?
Correct. I actually wrote the deed. My father conveyed his interest to our family home to me. So I actually wrote that deed to convey the interest to me.
Interesting. Nice. Cool. So what I'll do is I'll kick off the intro because a lot of stuff that you said there would have been kind of cool for the listeners to hear. So what I'll do is I'll just kind of let you introduce yourself. What's your last name, by the way?
Richardson.
Okay. And do you own your own practice or do you work for a firm?
No, I actually work for government. I'm a government attorney.
Oh.
So every so often, like somebody will ask me to do something, and I'll do it. Like every so often, someone will ask me to write a will or whatever, and I'll do that. But nothing that's a regular ongoing practice.
Okay. The only reason I ask is because a lot of what I talk about is business ownership. And so I was going to talk about how you started your own business, but you didn't. So we don't have to worry about that unless you didn't.
Oh, how I start my own business? Well, yeah, I have the IB Investors LLC under Commonwealth of Pennsylvania.
Cool. So we'll talk about that then. We'll talk about that.
Okay.
Here we go. This is the Todd Capital Millionaire Podcast. This is episode number 52. My name is Charles Oglesby. I'm also known as Todd Millionaire, founder and the director of the Todd Capital Investment Club that has over 185 members on the stock side, about 25 to 30 on the real estate side. We're doing some great things. We're turning small into a lot, and I'm very excited about everything that we've done and everything we're going to do. So if you haven't joined, you should join. We want you a part of our team and our family. So also the founder of Todd Acquisitions. We are under contract for property number 2. It's a great experience, a great learning experience for people who are involved doing it. Not only are they making money, but they're learning at the same time. They can take those skills, apply them to other things. Also in the process of Todd Ventures, which is super exciting. So many people are contacting us with their ideas. There's so much creativity out there. We want to fund those ideas, and we're getting there. So keep pitching us and we'll keep having that conversation. Thank you all for tuning in. The purpose of this podcast is to share the stories of successful African-American investors and business owners so that people can hear the stories of successful examples, see what's possible, and learn that business and investing are the true keys to financial success and generational wealth. With us today, we have the Ivy investor. Her actual name is Courtney Richardson. She is a JD LLM, past financial advisor. Her story is a lot like mine, which is why when I heard her spitting her truth, I was like, oh, she's one of me. So I know she can give herself a much better introduction. So with that, welcome to the show.
Thank you so much for having me, Charles. So just to kind of give a brief background about my story, I started in financial services in 2003 with a philosophy degree, a Bachelor of Arts in Philosophy. My intention was to go straight to law school because that's kind of what I've wanted to do all my entire life. Since I was 5 years old, that was the conversation that I had. People were like, what do you want to do when you grow up? You know, I had friends that would say, I'm a police officer, I would be a fireman, or whatever. And I'm like, I would be an attorney. And they're like, where did you get this kid? So I, my intent, with the philosophy degree was to go to law school. And I was kind of like burnt out from like school. Pitt's, I went to the University of Pittsburgh. Pitt's program is like bachelorates between 1 and 2 between Stanford, like in terms of the top philosophy programs in the nation. So it was a really intense program. And I learned a lot, but I was like, is that really what I want to do? I don't know. So I took some quote unquote time off. And I, of course, when you're graduating and you need a job, it's like, I'll take anything because I have a degree in philosophy. I was approached by American Express Financial Advisors, which is now Ameriprise, if you're familiar with them. And they said, hey, do you want to be a financial advisor? And I'm like, oh, I have 0 other offers, so why not? So I became a financial advisor. I was licensed as a general securities representative, which is a stockbroker, and I had which is a Series 7, and then I had a Series 66, which is it's basically the laws regarding securities, which allowed me to be an investment advisor, which also allowed me to charge people for my advice. So I did that. I had the opportunity to work in banking. I even worked with PNC. I worked for National City, which is now PNC. And I also worked with Merrill Lynch. So at Merrill, I did retirement work, and then I also did high net worth advising with separately managed accounts. And I was working the day the stock market crashed. So it makes so what happened with that is that I was laid off. And, the market crashed in September of 2008. And it was just a really, really crazy time. And I was looking to go to law school at that point anyway, because every time we were having these conversations with high net worth clients, when we were having conversations with trust, we always had to run everything through legal. And it was like, that's great. That's a great idea you guys have, but let's run it through legal. And it was like everything was kind of run by legal in these high net worth spaces. I was like, well, wait a second. I want to get down with them. I want to be like them. So that's kind of really what reignited my desire to go to law school. So I was kind of already prepared for the LSAT. I was doing that when I was laid off in March of 2009. I was like, okay, well, this makes sense. I was going to go part-time. I was like, I'm going to go full-time. Decided to go to law school. I spent a month in the Philippines, I guess, to get myself together. I don't know. Came back. I started law school in August 2009. Graduated in May of 2012. And the stock market crashing in 2008 kind of affected everything. So when I got kind of into the law arena, it wasn't as sweet as it used to be. So I was like, what am I going to do? But I found oil and gas. I liked oil and gas. It was kind of like property on steroids. I was very familiar with property because, again, when you start learning the rules of money, you start learning what kind of rules money, which is property and taxes. It was pretty much which rules money. So I was kind of like, okay, well, I understand property because I have this kind of background in finance. So I was like, okay, I'll do this. And I started learning oil and gas. I was like, this is dope. But then I want to be in West Virginia. I want to be closer home in Philly. And I really want to get into this tax thing. So I started my LLM in 2014, left the firm. I started in 2014, and I just finished up this past August. So it took me about 3 years to finish the LLM, which is kind of like it's LLM in taxation with a certificate in estate planning. So it's kind of like it's law school on steroids. It's super concentrated in tax. I know all the fun things about tax. And everything that I learned pretty much is out the door now with this new tax code. There's some things that are still the same, but a lot of things have changed significantly, especially the things that I studied, such as corporate law, estate planning, estate law, because a lot of things run by exemptions. And now that the exemptions have changed, you're like, whoa, this changes the whole plan, this changes the whole game.
Mm-hmm.
So it's kind of like the Wild Wild West now, because now no one knows what's going on. They have this new code, this new law, or the way we call it out in the field, we say basically we have 500 pages of code changes, not necessarily code. So it's an interesting place because we're waiting for regs and we haven't got them yet. So everybody's kind of pontificating and thinking we know what direction the regs are going to go. So that's where we are, and that's where I am now. I'm a government attorney by day, and I focus on the IB investor at night. I've been doing that since 14. In terms about just educating people about investing and finances and kind of making everything very plain and very simple. Because one of the things that I learned at Merrill is that a lot of the things that rich people do or wealthy people do that we look at, we're like, oh, they're wealthy, I could never do that. No, you can do those things just at a smaller scale, but you have to understand the rules of the game. You have to play it better than anyone else. And I think that was pretty much how I started. That's what I thought about when I started the IB Investor. How can I educate people for them to make good, intelligent financial decisions? Because it's not something that a lot of people talk about across the table, but it's something that you really need to know.
Very, very cool. It's funny because, like I said, my story is a little bit similar in that I was a financial advisor before I went to law school. And what's interesting is when I was working in financial advising, what I noticed is a lot of the advisors kind of wanted to be lawyers, in that the way they carried themselves, the way they presented themselves, they kind of like, they carried themselves as though they were on the level of as an attorney. And maybe they are, some were doing very, very well. And so I was thinking, like, instead of trying to look like an attorney or act like an attorney, why don't I just become an attorney? And so one day I was walking out the office, and there was this law firm on top of the firm that I was working at. I was working at Waddell & Reed at one point in time. And it was an African attorney. And so I stopped him. I was like, yeah, I'm thinking about going to law school. What do you think? And he said, if you're thinking about law school, go to law school. And then after you're done, you'll be thankful that you went. And I think that's kind of what pushed me over the edge, was just having somebody say, like, if you're thinking about it, just do it. So that was pretty cool. But what I really want to circle back, because I think there's probably a ton of value in your experience when you're still working as an investment advisor and as you're working for all those different firms. And I kind of want to ask, what lessons did you learn while you were working as an investment advisor and seeing different things at Merrill Lynch and at different firms?
There's always going to be another opportunity. I think that was pretty much the biggest thing that I got out of being in those spaces, is that I think when you look at things, and I'll get a little philosophical for a second, but when you look at things through the scarcity model, you think that if I don't take this opportunity, there'll never be another opportunity. But when you look at things through the abundance mindset, you're kind of like, there's going to be something else. And when you're in these spaces all the time, like, everybody's always concerned, like, well, if the market goes down, I'm going to lose money. And you're like, if the market goes up, I'm going to make money. It's like, oh, not necessarily. You know, you can make money if the market is up, down, or sideways, if you know what you're doing. Mm-hmm. And so that's what I mean by there's always going to be an opportunity. Like, the opportunity is not always going to be this kind of bright, shiny thing, but there's always something to do, and there's always a way to make money if you're willing to do the work. So that was pretty much what I got from it, is that, yeah, there's always going to be an opportunity. You know, you don't, and if opportunity doesn't seem right for you, there's going to be something else that's going to be right for you. Nice. So that's kind of what my biggest takeaway. Sometimes, and my second takeaway is really do it afraid. I mean, there's a lot of times that, you know, I was just thrust into a project and I really had no idea what was going on, and I had to get up to speed. And I was fortunate to work at Merrill, and Merrill had just a plethora of information that's available at our fingertips for us to kind of get up to speed on any financial product or any financial issue that was out there. And I got a chance to take lead on the auction rate securities right before the market crashed. It was pretty much the indicator that the market was going to crash. And I got a chance to really work on that project. And I had no idea before then. I mean, you learn about when you study for the Series 7, and you hear about this paper, you hear about 7-day paper, 30-day paper, you hear about this paper. And that's pretty much all you know about when you're studying for the 7. And I had to learn like the intricacies of this paper, because what happened is advisors were using that, they were using the paper same as cash. So paper is basically we'll call it a short-term note that resets at the end of the interval. So if it's 7-day paper, then at the end of the week it resets, or let's say it's available, it's on the market. So people are buying and selling it at the end of the 7 days. Well, what happens is normally that if there's not enough buyers and sellers on the private side, a big institution like a JP Morgan, a Merrill Lynch, a Chase, a Citibank will jump in, basically clear the market, make everyone liquid. What happened in February of 2008, the market failed. And a lot of advisors were putting people in paper instead of like going straight to a money market, because people were getting better returns. But at that point, kind of like the bottom fell out when the people weren't able to use their cash. And if they needed to get that cash at that time, they were getting about 70 cents on the dollar. So on your cash allocation that you think is quote unquote safe, you're losing 30% off top. So I had to learn all of the things that went into this paper, how the paper was set up, how we did it, how the auction works, why the auction failed, has this happened before, and there's basically a fail rate. And so again, so if you were getting, I don't know, I'm just going to exaggerate and say if you're getting 5% on this paper and then it fails, your fail rate may go up to 12%. So if you don't need that money, you're making money hand over fist. But if you do, now you have a problem. But again, there's always that opportunity. There's always the opportunity to make money. So just learning about that and learning about it on the fly to be able to be fluent and conversant in a way that mattered to the financial advisors that I supported to really kind of get us out of this jam. It was a great experience. But had I said, I don't know what auction rate securities are, I don't really understand them, give it to somebody else, I wouldn't have gotten that experience. Mm-hmm. And that experience really helped me kind of mold me into a better professional.
Yeah, absolutely. It's funny because, that's it. I was on Twitter like 30 minutes ago, and I just went on this whole huge rant about like just doing things afraid. And I was saying like, man, I wish I knew that when I was like 18, 19 in high school. Mm-hmm. Like, I wish I knew that the fear never really goes away. You just got to do it afraid. And then as you're doing it, then once you realize, I guess, that you're not going to die, then the fear goes away. And then the next time you do it, it's okay. Mm-hmm. And I mean, a lot of times you'll stay on the sidelines hoping that you get enough education or enough experience that the fear goes away, and you'll just waste years sitting there waiting, trying to get more experience or read more books or listen to more podcasts. And you can learn through doing what you would never learn by just reading. And I'm an advocate of reading. I read a ton of books, but I know that there's still limits on reading and knowledge through reading. So that's very cool. That's definitely something I operate under.
Oh, and you know what? I think the more educated you become, the more fear, the more risk averse you become too. At least I've seen that. I'm like, oh, I know, well, I've kind of run through the logic table in my head, and there's a probability that this is not going to work. And then some people are just like, well, I don't know, I'm just going to do it. And you look at these people and you're like, wow, this person's super successful. And you're like, I have all of these degrees, all of these papers. I don't know if you've heard of Kanye's college dropout, the first one. And he's like, yeah, I'm going to like lay under all of my degrees. And I kind of laughed at it, but I was like, that's pretty much what happens, is that you become so educated, you become like risk averse. Mm-hmm. Like, well, these 20-year-olds, it's not that they don't have any fear, but they just kind of just like, I'm just going to do it.
Yeah.
And you get that kind of like freeness about it. And they're just successful because sometimes you fail and you fail fast. You just keep doing something until it sticks.
That is the truth. It's so funny. I always tell my mom this. I always tell her, like, sometimes we can be a little bit too smart for our own good. Mm-hmm. And we miss out on opportunities because we know all the ways that it can and can't work. And so we'll just stay where it's safe and where we know things are going to work out, instead of launching out into the abyss of cryptocurrencies where we don't know. Like, in all actuality, like, we don't know. It could work out, it could not work out. But if you're somebody who has so much experience and knowledge in how other situations work, how other markets work, then you're going to miss out on that opportunity. So you're 100% right. Because you went in on me on that post. We'll talk about that post, hopefully, if I remember. But and I think this actually might be a time to dovetail into that, because I was going to ask you, since there's opportunities in every market, what opportunities do you see in this market?
Oh, in this market. Well, a couple of things. So on the very high level, just looking at kind of the way corporations are interpreting the tax code. If you are invested in the market and you have so let's back up. Let me back up. So the tax code changed the graded corporate tax scale to a flat rate. And why that matters is that essentially, I don't remember where it was at 50, so it was between 0 and 50,000 of profit was taxed at one level. And we'll say it's under 20%. We'll say 15 because I just don't remember offhand. But then you had this 50 to, I think, I don't know, it was 50 to more, 50,000 up with something else. And then at $10 million, you had the top corporate rate, which was 35%. And that's what a lot of our big companies do. A lot of our big companies like our Apple, our Microsoft, they're already at that $10 million profit. And we're getting taxed at 35%. So they're already automatically going to get a hit to their balance sheet because, or I'm going to say get a pump of cash to their balance sheet because they're dropping the corporate tax rate on that money from 35% to 21%. So that's automatically just going to be a flush of cash. And a lot of people are saying, oh, they're going to put more jobs out there. And the jobs really aren't going to be there, at least not right off top. We'll just say right now. But what is going to be there is going to be those profits, and they are going to push those out to investors. So the dividends, I'm expecting dividend checks. I say give you all that background. I'm expecting dividends to increase. And if not the first quarter, I would probably say second quarter 2018. So a lot of our big dividend players, I'm expecting a lot from them. So that's kind of where I'm looking at. So I'm looking at like dividend stocks. I think they're going to be doing a lot. Also, I think cryptocurrency is an opportunity, and I think it's an opportunity for us to kind of do things afraid. I think this is a really good speculative opportunities. Like when our parents were investing, like they were speculating in pork bellies and oil, or something like that. So this is kind of like our generation speculation. Now, do I think that everybody should go out and buy crypto? Probably not. One, I think currency just generally should not be a really large portion of your portfolio. I say usually 5 to 10% at most. But I do think that one thing, even if crypto went away tomorrow, I think there's a real value in the blockchain and that technology that kind of runs the crypto bust, for lack of a better term. So I think there's an opportunity in that. There's a couple of ETFs that are floating around. There's 2 blockchain ETFs that kind of hit the market relatively recently. And then there's a Bitcoin ETF, and then there's going to be Ethereum ETF, I believe, rolling out this spring. So there's kind of a couple of different opportunities in that crypto space that's not necessarily, you going out and buying cryptocurrency, like buying coins. So that's a really good opportunity. Also, I just think I think there's going to be some really good spaces in real estate also. So I don't want to just focus on the stock market. I think there's going to be some really good spaces in real estate because as companies and corporations get more money, they're going to look to do some building. They're going to be looking to do some infrastructure. And I think this is something that people are like, as Amazon is looking for its next headquarters, I think wherever that space actually is in the nation. I mean, I think there's a short list that includes Philadelphia and Pittsburgh. But I think wherever those spots are, it's like there's going to be a real estate boom there. So I think there's a couple of different places where we can kind of hang our hat on being an opportunity. And I think at some point we're going to start playing with the interest rates. I think the Federal Reserve Bank is going to try to, once all this money starts circulating from the corporation side, and I don't believe that trickle-down economics works. I'm just giving you that there's going to be some money floating around, not necessarily anything that I think is going to be in excess, but I think the Fed is going to kind of try to pull back and increase the interest rates. So I think that may happen. So I think we may want to start looking at the bond space, because I think we stopped looking at bonds because bonds haven't been sexy in years, but I think they've become less sexy because their yields are just so terrible. But now I think they're going to start increasing. They were okay around, I would say maybe 08, 09 when the market was trying to rebound. I think we may see some of that coming in the next couple of months.
Absolutely. I agree. I think there's a ton of opportunity out there, just as long as you're looking at it the right way. I'm super bullish on American business. I think that it has probably never been a better time to start your own business. And I'm seeing a ton of that just amongst African-American entrepreneurs, which I love seeing. Not only are we starting our own businesses, but we're supporting each other's businesses. So that's very cool. So what are some, because a lot of young professionals are making good money, but I don't know if they're really planning for their taxes the best way to make sure that they're paying the least amount and taking advantage of exemptions and all that good stuff. So what's some advice you would give for a young professional out there making good money, not a lot of no dependents? How can you help those people?
Well, I think the biggest thing is reducing your taxable income. And the question is, well, how do I reduce my taxable income? And the best way to do that, especially where we are now, is start contributing to the retirement account. A lot of people do not contribute to the retirement accounts, and they're not even contributing. So there's a couple of things. You can max out. People talk about retirement, and there's two max out terms. So you can max out your employer's match, which basically means that you're contributing enough to get the entire employer match. But then on top of that, it's actually maxing out your yearly contribution, which I believe in 2018 is like $18,500. And a lot of people are making good money, and it's with a little bit of kind of like trimming back, you can actually max out. A lot of people can. I have a lot of friends that are able to max out their retirement, and I tell them, you're getting beat over the head in taxes. You just really are. There's not enough mortgage interest in the world that's going to make this worthwhile. So you have to do something that's going to give you a benefit now and something that's going to give you a benefit later. And one of the top things that gives you a benefit now and a benefit later is tax deferred retirement account. So you're taking money off your taxable income and putting it into an account. And then on top of that is that money will be available and it's growing tax deferred all the time, until you retire. And it comes out, it's taxable when it comes out, but you can actually measure your taxes as you take it out. A lot of people think, oh, I have $100,000 in this IRA when I retire, I'm going to get taxed at $100,000. No, not if you don't take it out. If you take out a little bit, you only get taxed on the amount that you take out, only the amount that you use. So it's kind of like maxing out that retirement. Also looking into property. I think property is, when I say initially looking into your first property, looking into your home. Now, your home is not an investment, but it does help you kind of tax-wise. They have reduced the state and local deduction to $10,000. However, but a lot of places, at least in Philadelphia, unless your property is like, I'm thinking like about $750,000, you're not going to get anything close to that $10,000. That's where you're starting to get into the gray area of, not being able to claim all your state and local taxes. But for the most part, in most places other than New York and California, you're able to kind of deduct your property taxes on your taxes. But then also you have the opportunity of deducting your mortgage interest. So those are kind of getting those houses. Is that okay? I want to have a place to live once I pay it off. Basically, it can't be taken from me unless I, default on my real estate taxes or something. But that gives you a place to live, but it's also giving you that kind of that benefit now of the deductions. But then also you have a benefit later in terms of having a home that's completely paid off. So, retirement, getting into a home. Also, in terms of tax planning generally, I think you talked about it earlier about getting in front of it. A lot of people are like, when you go to do your taxes in March, April, or whenever you do them, your amount that you're getting back should not be a surprise. Like, we shouldn't be like, oh, look at that. I got XYZ back this year. Woohoo. This is a surprise to me. Like, no. That means you're not doing it right. So you have to see, hey, I personally like a little bit of a refund. And I mean, and there's some things that I just can't necessarily, like, I don't know what my business expenses are going to be because I do have an LLC. There's certain things that I can't really manage for. So sometimes, and then sometimes I also have to pay business taxes. So there's a lot going on with me personally, but I try to at least get on top of things and say, okay, because if you have a business, you probably should be paying your quarterly taxes. So that's something else that you probably should be looking into. So again, that's a reason, like if everybody's kind of running to open up businesses, you have to be compliant because there's nothing worse than getting a surprise tax bill or a surprise audit letter in the mail. That's not fun. So you want to understand, like, okay, I had XYZ coming in from we'll call it my W-2, my job, my regular 9 to 5. I have this W-2. I may do some side work, so I may get a 1099. I also have, so some of the things that you can control, the work that you do, the 9 to 5, we'll say the consulting, the kind of like off the cuff work that gets you a 1099. You can control that. A lot of people with Uber and Lyft, they get those 1099s, and a lot of people I know that picked up Uber and Lyft are going to be super surprised in a couple of weeks when they get this 1099. They're like, oh, I didn't pay any taxes on this. They're going to be sad. So again, you want to make sure that the things that you can control, you're making sure that you're paying what's due and what's owed. Because I don't want to pay more than, like, it's kind of like if you go to the store. They're like, oh, if I go to the store, I'm going to give them more than, would you really go to a merchant and give them more than they're entitled? Of course not. Same thing with the IRS. I'm not giving you more than you're entitled. So I need to plan on the front end to make sure that we're even Steven at the end of the year.
Yeah.
And the only way that you could do that, and the best way to do that, is to do that now in January.
Yeah.
A lot of people are like, oh, I'm gonna plan, I don't know, we'll do it in September. Well, you've lost, 3/4 of the year, and you're not able to like really recoup that. And especially if you're going to max out a 401k, you need to calculate how much you need to contribute every paycheck to get you to the end of the year. And a lot of people don't do that. And a lot of people are like, oh, I can max out. And they try to dump a lot of money as much as they can in your 401k. But a lot of 401ks have rules about how much you can contribute, kind of in terms of a percentage. So you end up jamming yourself up. Again, you have to know the rules of the game and play it better than anybody else. So you manage your income that you have coming in. And there's other things that you can't manage, like your investments. If you get dividends, can't really control that. You want to get dividends, but they're taxable. Same thing with anything else that's kind of like this investment stuff. When you're dealing with, if you're doing any flips, if you're doing any buy and hold, sometimes you really can't determine how much you're going to get. You can do projections, which is always important to do projections. And I would do that in the beginning of the year, just so you have an idea of how much you should be paying and how much you are going to pay, and if there's going to be an overage or a shortfall. And when you sit down, a lot of people are like, oh, I can do that myself. And when you start making money, you have to level up your squad. So, TurboTax is not going to work for you anymore, So you need to say, okay, I'm going to get myself a CPA. I'm going to get myself a EA. I love enrolled agents. Enrolled agents are like my favorite people because they're not as expensive as a CPA, typically, but they also have a very good knowledge of the tax code. And they're just not, they can be pricey, but they're usually not as pricey as their counterparts, which are attorneys and CPAs. But they have great knowledge and great working knowledge of the tax code and really can help you save money. Because a lot of the tax planning is not like, oh, how much money am I going to get back a year, but how much money can I save in deductions and making sure that I'm keeping receipts and all those things. Because if you're running a business, you have a lot of ordinary and necessary expenses of business that are deductible, but you have to make sure that you're documented. You have to make sure you have the receipts. So you have to keep those. I try to keep a receipt envelope and it's terrible, but I have an envelope for every month. I'm like, okay, last year in April I went to Chicago and I have my Chicago receipt in the envelope that says April, and then it says Chicago from this date to this date, and I have all my receipts there. So when I go and get my taxes, when I actually sit down and do my taxes, I do them. When I sit down and do my taxes, I'm like, okay, this is what I had. This was what I had in April. But you can't do that. You can't try to rustle those up in March when you're trying to see your accountant, in a couple of weeks, because it's not going to work. So it's just about all this planning.
A lot. Sorry. Now, there's a lot that you said in there. I think one of the things that you said that kind of resonated in it paralleled something you said in the very beginning, is that a lot of times people see the things that wealthy people do and they think they can't do them, but you just do them on a smaller level. And one of those is planning your business affairs in line with the tax code. one of the things that they do in this office is at the beginning of the year when they're looking at projects, I work for a company that builds homes. And so where they're looking where they're going to build homes or what kind of homes they're going to build or what they're going to put onto those homes. Are they going to put solar? Are they going to build with these types of materials? Are they going to hire these kind of people? All those things help you reduce your tax bill with credits. And so if you qualify for certain credits, then you can reduce your tax liability. So that's one thing. Another thing that you said that I really liked, it sounded like you were going there, and it's something I've always said is like, you have these people who are making great money. Like, you're overqualified for H&R Block. You're overqualified to have your grandma do your taxes still. And that's not a bad thing. It's actually a blessing. It's like, congratulations, you're doing well. Now level up your team. It's like Jim Morrison always says, it's like, you can't get legal advice from the dude at the barbershop. You got to get legal advice from an attorney if you're going to take your finances and your business serious. So I think that that's huge. And I definitely agree with you there. One other thing that it sounded like what you said, and a lot of people are traveling. And what was so cool is you're able to write off certain things when you travel. And so I don't know that a lot of people know that, but that's kind of like what the wealthy people do. When wealthy people travel, it's a business expense. It's a business event. It's traveling for business. And so they can write off that money on their taxes. So can we talk about that? Because you said you have a business, you have an LLC. How are you using your LLC to strategically plan for your taxes?
Well, so I have an LLC, and I started the LLC. Oh, gracious. So I've had it for about a year and a half. So the Ivy Investor, like, I started as a blog, and I kind of just was writing, and then people were like, "Hey, could you talk to us about it?" I was like, "Okay, that's fine." And then they're like, "Hey, can you talk to us about it in Chicago?" Oh, okay. And so what I end up doing is that I'm saying, okay, well, if I'm going to go to Chicago, I'm here for business, because I am. I mean, I'm there to speak. And depends on how I get paid, and if I'm getting paid, or if it's a nonprofit or whatever, I write off my flight because I'm going there for business. If I'm there eating, like, I'm there for business, I write off my meals. And it just is, again, the definition is the ordinary, like, a necessary expense of business. Like, when I'm on a business trip, I have to eat, but I'm not going to Shake Shack. Like, that's not a business expense, at least for my line of business. I mean, that may be for somebody else's, but if I'm speaking on investments and I'm basically a public speaker, Shaky Bus is not on the list. So I tell people that all the time. It's like, again, because what I've noticed is people were like, I'm taking my kids to Disney, and while I'm down there, I'm going to go look at some properties. Okay, that's fine. You can do that, but you have to prorate everything. So if you spend like 5 days down in Disney and you only spend 1 day doing business stuff, you can't write off 5 days of Disney. No. You can write off 1 day of Disney. And a lot of people, that's where people get audited. I don't have a business space outside of my home, but I do have a room that I use for my business. So I have to take the dimensions of my room, and I say, okay, that portion of my house. Now, there's some what we call safe harbors, but I say that portion of my home is for business, and that's a business write-off. Does that make sense?
Absolutely.
So those are the things. My cell phone. When I use my cell phone, I don't really like sit down and go, okay, this call was for business. I do say, okay, I can look at my phone and say, okay, about 25% of this month was business related or whatever. So I try to do things that are in line with the rules, that require a little bit of planning, knowledge, but that are not going to get me audited. Because a lot of people go super, super left. They're like, I'm going to write off everything. No, you can write off you can. And then when you get audited, you're going to give all that money back, plus interest, plus penalties. So I try to really be careful about what I'm doing. I also run it through like my friends and when I say my friends, like my account friends, my CPA friends. I'm like, hey, am I doing this right? Because again, I'm a tax attorney, but my specialty is estate. So every so often, like, I know the code. I'm like, okay, yeah, I know the code. Sometimes you have to check yourself. And again, it's about like leveling up your circle. I have to double check myself sometimes. Like, did I do this right? And sometimes my friends will say, no, you're making that up. They're like, cite the code. I'm like, oh, I mean, I think that was my interpretation. I read the reg. So, but again, it's about kind of really understanding what's an ordinary necessary expense of your business and then working from there. But that's how you do that tax planning, is what's ordinary necessary for me. Like if I am a ski instructor, my skis that I'm buying, if I'm buying skis every month, well, I'm doing it because it's a part of my business.
Mm-hmm.
So.
Very cool. I like what you said about leveling up your circle. Sometimes I think that education helps you level up your circle. It's like when you go to law school, all your friends are now attorneys. You go to grad school, all your friends now have an MBA, or all your friends have an LLM. So it's kind of a hack. A lot of people don't realize that.
That's true.
One thing that I heard you talk about on another podcast is you were talking about strategically planning your exit strategy so that you can get the most bang for your buck tax-wise.
Okay. Yeah.
Can you talk about that?
Okay. Well, we were talking about that through real estate, but it's also, I think, it's just generally any investment. It's super important to say, okay, you have to begin with the end in mind. You have to say, okay, what am I trying to do with this property? What am I trying to do with this investment? Am I doing this as a flip? So basically, I'm going to buy it low, I'm going to fix it up, and then I'm going to try to sell it as high as I can. Or am I buying this as a kind of like a partial flip? And what I mean by a partial flip is that I'm basically buying a property that I have to do a lot of rehabbing to, but instead of me selling it, I'm actually just bringing it up to market rate and I'm going to rent it for a time. Also, you have the opportunity that if you're kind of staying in the real estate game, and this is only in real estate, you have the opportunity to defer your gains. But again, and what I mean by that is called a exchange. And just to kind of make it very simple is that, if I'm going to sell a property, but I'm still in the real estate game, if I see another property that I'm going to buy, I can actually use those proceeds and buy that property and not take on a gain. So if I purchase a property for $100,000, I sell it for $200,000, so I have a gain of $100,000. We just make it really simple. I would normally get taxed, and we'll say it's a long-term capital gain because you can only do 1031 exchanges if you're holding the property longer than a year. But sometimes it is intent, and that's why you need it, because sometimes it doesn't end up being longer than a year, but the intent was for you to hold it for investment purposes. And that's kind of the crux of the law. So are you holding it for investment purposes? Mm-hmm. But you're saying, okay, I have this capital gain that I'm going to take. It's going to be 15%. I'm going to have to give the government of my $100,000, or I can use $100,000 to buy another property. And then I can defer that gain. So basically it's like tax deferred growth. And I can use that and then kind of flip it some more. And I mean, and some people use these 1031 exchanges ad infinitum. So they just never do anything. So when they die, they're like, okay, I guess we have to take this. We just have to take this gain. We just have to take this L. But a lot of people do that. And it's like they're able to kind of level, like we're talking about leveling up. They're able to level up their investment. So they're saying, okay, I have this, single family home, and now I'm in a multi-family. I flipped that. I moved it into a multi-family property, and now I moved it into an apartment complex. They can keep doing that just to kind of really level up and not end up own more and have more assets, but they're not taking those taxes. They're not making it a tax thing. Mm-hmm. And I think it's super important to know that, because those 1031 exchanges require a lot of planning. And before you kind of hit the trigger on the whole process, it's very time intensive. Everything has to be done very quickly. Mm-hmm. So again, you have to know what you're doing when you're doing it and when you're trying to get out of it, because if not, you're going to get kind of caught holding the bag. It's kind of like that hot potato thing. It's like who gets caught holding the hot potato. And you don't want to do it that way. So if you begin with the end in mind, like, okay, my intent for this property is X, my intent for this investment is Y, then you know what you're doing. So when it happens, you also take the emotion out of it. Because I think, especially with the stock market, not so much with real estate, but I have seen this a little bit with real estate, is that people get kind of emotionally attached to these holdings. Mm-hmm. And they're like, oh, I think Kmart's going to come up. That doesn't even make any sense. But if you say, listen, I've got into this particular investment at $100, and now if this investment hits $500, I'm getting out. No matter where I am in it, I'm getting out, because that's what my intent was. My intent was to make $400 in profit. I'm out, no matter what, because a lot of people kind of hold on, and they hold on too long. Yeah. And now, granted, I'm pretty much a buy and holder, so I pretty much buy and hold everything. But every so often, I will go into an investment with the sole purpose of making a profit and getting out. Yeah. If you remember, I don't know if you remember, it was right before before President Obama left office, the Department of Justice made a statement, said they're getting out of private prisons. They're not using private prisons anymore. And all the big private prison stocks dropped dramatically. It was like 65% in one day. Basically, it was crazy. And everybody was like, oh my gosh, just in the private prisons. But if you know anything about private prisons and you know anything about the government relationship to private prisons, is that the major entity that holds private prisons is not the Department of Justice or the DOJ, it's ICE, which is Immigration, Customs, and Enforcement. And Immigration and Customs and Enforcement didn't say anything. And if you know anything about government kind of press conferences, press releases, if two agencies are doing the same thing the same way, they normally will make a joint statement. In this case, there was no joint statement. I was like, oh, well, I know enough to know ICE is not doing anything. So this is kind of like an artificial drop. Now, I don't believe in private prisons, so I knew I was getting out, but I was like, oh, no, I'm going to make this quick money. And I did. So I doubled my money in like 3 months.
So did you short it or did you just buy the bottom?
Oh, I went long. Long.
Nice.
So I went long, and it's not, again, because it wasn't like, oh, yes, I just know that I can make, that I know what I'm doing. But again, I said, once I make this profit, so I just wanted to return to its regular level, whenever that was going to be. And once I made that profit, I was out. And in this case, it was it was a very, very short time because that's when the election happened. Yeah. But again, it's like you begin with the end in mind. I knew once I hit something that I was going to get out. Once I hit a certain price per share, I was out. Same thing with the real estate. If I say, okay, I know if I'm going to, if I can make this XYZ profit, this is what I'm going to do. I'm going to get out. I'm going to sell. But a lot of people are just like, oh, no, I think I can get more. And then they end up losing the deal. Mm-hmm. So I think sometimes you can hold it too long.
Yeah, that kind of speaks to what Aisha Selden calls being a disciplined investor. And so you have to kind of stick to your guns. You have to stick to your principles. You have to stick to your plan. So many people that I know that are successful, from Aisha to you to I forgot her name. Trader 9 to 5. She says she never trades without a plan. She never invests without a plan. And so that's key. Like, you don't ever want to get greedy. You never want to try to overextend, or what they say, turn a trade into an investment. So very good advice. So I had some questions from people on the internet. I promised them I would ask these questions.
Sure.
So I might be duplicating, but I'm pretty sure we can pull some more out of it. So the first question is, what are 3 of the top tax decisions / moves a person can make?
Okay. So I think the top one, we've talked about this before, is planning. Is to sit down with a accountant, a CPA, a enrolled agent, and planning out your taxes, like planning out, where you are. And I also think that part of that planning and sitting down and sitting with a financial advisor, because again, your accountant people are going to know like kind of like what's going in, what's coming out. But your financial advisor should be a person that can tell you, you can say to them, hey, I want to retire at age 70, age 55, whatever. They should be able to help you with that plan, and they should be able to work with your tax person to kind of make that happen. So sitting down and doing a plan, doing a financial plan, and not doing one in isolation, doing it together, like doing it with your team is super, super important. In terms of taxes, also, and this also depends on where you live, and this is kind of like a little asterisk when it comes to your planning, is that you have to plan out, your death. And I think that sucks, and it's just not fun. But there's 2 things that are certain in life, which is death and taxes. So they kind of roll hand in hand. In the Commonwealth of Pennsylvania, there's what's called an inheritance tax. So anytime that you convey property, that someone receives, is actually on the receipt. If someone receives property as a result of someone's death, there's a tax associated with that. So all your power of attorney, you should do those also when you sit down and do your planning, but also planning what those tax liabilities may look like and finding ways to actually deal with them, which is maybe, getting insurance to make sure that you're not having to pull out of your investment or whatever you have to basically satisfy tax liability. So I kind of put like a little asterisk there. So in terms of planning, is like the best tax decision that you could make. two more. Oh man. I I think I'm kind of stuck on that in terms of anything else of which you should, the top three things. That plan is so important. It like runs everything. I can't really think of anything else offhand. Can we come back to that?
We can definitely come back. And honestly,
okay.
I've never heard anybody say to plan with your CPA and your financial advisor at the same time. That's a bar. I've never heard that, because I mean, you do need a board of advisors. Man, there's a question that I want to ask you, because Robert Kiyosaki always makes this point. He always says that the tax code is written in a way that it is supposed to influence certain behaviors. And
yes, very much so.
Usually those behaviors are like investing in business ownership and housing and all those things. What are your thoughts on that statement?
Oh, I say that all of the time. The tax code definitely drives business, and it definitely incentivizes certain types of behavior. So we talked about, like, there's a lot of things in the tax code that are specifically for real estate. Like that 1031 exchange is only for real estate, and they were trying to use it for cryptocurrency in the tax plan. This new tax plan actually put the act on that and basically said, in no uncertain terms, this doesn't apply to anything other than real estate. And then also, the tax code incentivizes long-term investing. So what that means is that you have short-term capital gains, which is anything less than a year. You have long-term capital gains, which is anything over a year. So if they're incentivizing long-term investing, they're going to give you a better rate if you sell something that you held for over a year, which is your long-term capital gains. But if you have short-term capital gains, it's at your ordinary income tax rate. So you're end up paying more for holding an investment shorter than a year for a shorter time period. Mm-hmm. So and then also there's a couple of things that are in the tax code that a lot of people don't know. There is an excess profit kind of like tax that's levied on corporations that basically, and granted, it's not something that's used quite often, but it's definitely something that is that's kept in mind with corporations, is that the reason dividends don't happen because the corporation loves its shareholders. It's just, they just don't. That's not, I mean, they may, I'm not going to put that on them, but it's really run because of the tax code. So if you had the IRS finds, or the Treasury, I should say, the service finds that your company is kind of basically hoarding profits, they're going to give you a tax on that of 15%. So basically it's incentivizing corporations to push out dividends, because remember, corporations have two levels of tax. They have it on the corporate level, which is on the business level, but then they also have it on the level of the shareholders because their dividends are taxed. And we kind of talked about that a little bit earlier. So they're kind of forcing, the company to kind of pay their dividends to their pay dividends. And if they're not paying dividends, they have to have a reason to not pay. So if you notice, a lot of tech companies don't pay dividends because they always have some kind of R&D like kind of pending that they can kind of say, well, this money is earmarked for this thing. But some other companies don't have that kind of, we'll call luxury, to say, I can just park ungodly amounts of cash in my business because I have R&D floating around. No. R&D is research and development, or a patent pending. A lot of businesses can't do that, so they're forced to do that. They're forced to push the money out. So that's another thing that kind of, the tax code drives a lot of this business. Yeah. What else? In terms of, we'll say, also in terms of the way, on the personal level, the way people dispose of their assets. So if I have stock, I'll just call it by name, step-up basis. So if I'm incentivized as a person to hold something and not distribute it before I die. So if I purchased Google stock in 2003 at $100 a share, and who knows where it is now, so we'll say $1,100. We'll say it's Google's at like $1,000 because it just makes life easier. So that $900 gain basically goes away if I convey it to someone, if they get it as a result of my death. So so instead of them getting bases of 100, which means they're going to have a gain of 900, because that's what happens if I give it to them before I die. But after I die, they get the fair market value at the time of my death, and that's their basis. So again, that kind of $900 in gain just kind of disappears into the ether. So again, it's kind of like this long-term investing idea that they're incentivizing. So that's another thing. So there's a lot of things that kind of that the tax code incentivizes, and I think you really do yourself a disservice by not knowing what those things are, because you might end up kind of making a misstep. Like I said, like for example, with flippers, a lot of people are like, oh, that's short-term capital. It's not. People are like, oh, it's capital gains, but it's like not really, because flippers are considered, the properties that they're flipping are considered inventory. And a lot of people don't realize that. So they're like, oh, if I flip, then I'm going to get this tax result. But if you don't know the pieces kind of the chess game, you might get burned by not understanding. Again, remember, the IRS doesn't want you churning stuff like that, which is fine. If you do it, it's okay. But you have to understand that this kind of behavior is not going to be looked upon and get this favorable tax treatment. But if you hold properties, you kind of have them for investment, you hold them longer than a year, then the IRS is like, okay, fine, we're going to give you a better tax rate. We're going to give you these options of you being able to defer your gains. So it kind of, once you know what's going on and kind of how these things all work together, you can actually efficiently tax plan in a way that actually keeps more money in your pocket.
Absolutely. Through the same activities, just with a different strategy. I have a few quick questions. We're going to wrap it up. Just kind of fire them off to me, and then I'll let you kind of tell us where we can find you. The first question is, who is someone that you look up to in business, and why?
Ooh. Let's see. So I kind of have like friends in my head. So there's a young lady. I'm actually in a mastermind. I'm in a mastermind of tax professionals, and it's one of the tax professionals in my group. She's maybe like 10 years my senior, but she's a CPA. She just is doing it, and I look to her for ideas. I look to her for inspiration, because she runs her business in a way that I think is very efficient. So kind of, she's like my hands-on kind of like, I can reach out and touch this person kind of person. But then in terms of like my high level people, I look at Oprah. I love what Oprah is doing. I just really like her brand. I really love Jay-Z, because I love like a good comeback story.
Mm-hmm.
So those are people just in terms of the way they do business and the way they run. I had a friend today. She was saying that she was going to pivot in her business, and she said that she was thinking about closing her doors. And I said, that's okay. Remember, Hov retired and he came back.
He did.
So I use him every so often, and I did like a blog post on 444 during the summer, but just I use him every so often because I just think he's a really good story of kind of, doing your own thing, kind of running your own race, kind of setting your own pace and trying things and like, okay, this didn't work. Okay, this didn't work. And he also talks about, I just loved his conversation 444 because I felt like he was like, listen, I made a lot of mistakes kind of coming up. There's a lot of opportunities that I missed, and I like people who are very transparent. So between Jay-Z and Oprah, and then kind of like my friends in my mastermind that I kind of just really look up to, those are the people that in business that I'm into. Oh, Simon Sinek is like my other friend in my head. Like he just, he like his start with why really kind of helped me refocus my business. He also has a book, Leaders Eat Last. Mm-hmm. Also a really awesome kind of idea I haven't gotten to. I kind of I was reading like Start With Why, and then I kind of got hooked on Simon, and I was like, what else does he do? So he's like, that book is on my list, but just him as kind of the way he strategizes.
Yeah,
and I think Steve Jobs, because I did like a kind of like a overview of Apple as a company. And I saw how his influence on the company and their strategy really made a huge difference. So it kind of just reminded me that strategy is super important. So those are the people that are like my friends in my head. And then I had my friends on the ground.
Dope. What is your favorite book?
Oh, my favorite book. Unlabeled by Mark Zucco.
Never gotten that one before.
It talks about his brand, like, and how he kind of got into Echo.
Mm-hmm.
It talks about how he named his company, how he kind of walked through this whole experience about his company. And I just thought it was the dopest thing of really, like, he's not that much older. So it was kind of like, okay, he's not that much older, but he really took something that he loved. Like, he was airbrushing things, like, and he kind of took that to the next level. So it was kind of about taking your talent that you're given and actually monetizing it. And it's basically doing things that you love, that you wouldn't get, like, you're doing something that you absolutely love, and you would do it for free, but actually monetizing it. And I just think, when I think about business, when I think about just life in general, I kind of think about that book. I like it. That is my favorite book for now.
Last question is, what does wealth mean to you?
Wealth means freedom. Wealth, it means that I can do what I want when I want, and I don't have to do anything that I don't want to do. In terms of, like, with my time, it's kind of like freedom and availability of having my time to myself. Like, when I work, I have to work because I don't have enough money not to work. So I have to get to work on time. I have to do these things. When you have wealth, you're not kind of pushed in that way. Now, there may be other things that you kind of have to do, or there's kind of should do. There's not something that I have to do every day to make sure that, like, my lights stay on. So that's kind of like that freedom of time.
Dope. Cool. So where can people find out more about you and your brand?
Well, you can find me online on my website, www.theivyinvestor.com. I'm also on Facebook as facebook.com, The Ivy Investor, Instagram, The Ivy Investor, Twitter, but I don't see that much, The Ivy Investor. And that's pretty much where I can be found. I'm usually hanging out on Instagram the most. I do a little bit more on Twitter. I will be doing a lot more blog series. A lot of people have been asking, kind of like, I need more information about retirement. I need more information about college planning. So I'm kind of going to start doing a lot more series type work. And, I'm doing some webinars. I'm doing a little bit more cryptocurrency conversations because I think it's just a really cool thing. So I'm doing a little bit more of that too. But that's all going to be on the website.
Very cool.
Thank you.
Awesome. So thank you for coming on the show. I think that we haven't gotten a chance to really talk about tax. So I think you gave people a ton of information. Anybody who's looking to invest, if you have any questions, I'm sure she's open to you contacting her. So take action on that. This has been episode number 52. My name is Charles Oglesby. Thank you all for listening. We're doing great stuff, man. And I want you guys to be a part of it. I want to see you guys taking action, making progress, and then coming back to us and sharing with us what you've done. So feel free to contact us, letting us know that you took something from a podcast or this podcast in particular. We'd love to talk to you. You can contact us at info@capitaltodd.com. My name is Charles Oglesby, also known as Todd Millionaire, signing off. Very cool.